Welcome back, everyone. Michael here with Offshore Citizen, and today I'm going to pose a little mystery to you, a little riddle that I would love for you to think about if you can kind of figure out the way that it goes, and then later on in this video I will reveal the answer to it. And this is, there's a treaty that the US has which is only one way, meaning that if you go and you ask the other country on the other side of the treaty, they will say the treaty does not exist. But on the US side, it does exist. So I'm going to explore a little interesting piece of history with you today about how this came to be, about how the world changed, and how this is actually a really interesting opportunity for Americans to take advantage of if they are interested in doing business abroad, if they are relocating abroad and need to operate through some sort of a foreign company. It is something that I don't hear other people talking about. In fact, I've never heard it previously discussed, but actually it opens up some really interesting opportunities that I've used for clients over the last while. And so we're going to discuss it today. It is kind of remarkable and interesting and yet highly unheard of. So we're going to discuss today the bizarre quirk in a very particular American treaty. Let's go. Before we do, if you haven't already, please hit the subscribe button, hit the all notification bell. If you would like help with building holistic, customized, personalized to you strategies for internationalization for you or for your business, to optimize your tax, to live in a better place, to elevate your quality of life, to have a plan B, to protect your assets, to just have an overall better set of opportunities, then please reach out to us. You can book a call with me, calendly.com/Michael-Rosmer. There's a link in the description below, or send a message through offshorecitizen.net. We can help you with both figuring out the best solution for you as well as implementing that solution. I'd be happy to help you with that. All right, let's dive in. So here's the history. Tax treaties specifically, which is what we're talking about, are something that really sort of got going. This particular treaty came about in the 70s, and at that point in time, tax treaties were a relatively new thing, okay? They weren't something that was commonplace. Although treaties themselves go back, hundreds or thousands of years, tax treaties are basically an edifice of the post-war era. And so in the post-war era, especially starting around the 70s, they started to grow in popularity, and they went through, I would say that era lasted until kind of the 2000s that they became popular, and now they've kind of had declining popularity, I would say, replaced by other tools. This is particularly tax treaties. And what you'll see if you go and you study these treaties, you'll find that they've evolved. They used to be much simpler, and now we have sort of OECD model conventions. The US tax treaties tended to standardize, etc. Well, one such treaty that was made in the 70s has this really bizarre characteristic of it. And so for anyone who's already kind of thought over, I'm curious to know, what do you think that treaty is? Go and put it in the comments below, and we'll check and find out whether you're on point with it or not. So the treaty that I'm referring to is the treaty between the US and Georgia. And what's interesting about this is if you go and look up a list of Georgian tax treaties, you will find no Georgian-US tax treaty. But if you look up the US tax treaties, you will see a Georgian-US tax treaty. And what is the reason for this? The reason is because the original treaty was actually with the Soviet Union. And when the Soviet Union dissolved, the US decided to acknowledge and basically treat all former Soviet republics as having a tax treaty with them. But those countries did not necessarily consider the same. So Georgia said, well, we're an independent country. We don't have a tax treaty with the US. The US said, Georgia's a former Soviet state. Therefore, we're grandfathering in the USSR tax treaty with Georgia. Now, this treaty is super interesting and super unique amongst most of the treaties within the US. So generally speaking, you'll have about 25 articles in a typical OECD model convention. This one has almost nothing. It's like very, very scant. Much fewer clauses because it was much older. This was, before they had evolved the treaty formation process and standardized it and learned lessons about how the treaties should be or shouldn't be. And notably, one of the things that came about in the US standard conventions was something called the limitation on benefits clause, What this means is that the treaty doesn't apply in certain cases. So I'll give you a really common example. The tax treaty between UK and the US is one of the most favorable in terms of the dividend withholding rate. So having a US company owned by a UK company will give you a 5% withholding rate if dividends are paid from the US company to the UK company, all right? And this turns out to be lower than almost all the other treaties that they've got. And so it's one of the most tax-friendly ways to get money out. The problem is the limitation on benefits clause states that it only applies if the shareholders of the company also live in UK. Otherwise, you have a variety of different other factors that start to come into play. And so it's not useful for everybody. Well, the very interesting thing here is there is no such limitation on benefits clause within the Georgian US tax treaty. It's also worth noting that tax treaties are useful for Americans because a foreign company that is paying a dividend to an American is subject to the long-term capital gains rate if there's a tax treaty with the foreign country, but the short-term capital gains rate if there is not a tax treaty with the foreign country. Now, in kind of the post-2017 era, there is a way that you can have a foreign company held by a US C Corp, and by doing that, you can get these dividends tax-free, and so you can kind of add an extra layer to achieve sort of the same thing, which is nice, but adds this layer of complication. What is really optimal if you want to have simplicity is to have the foreign company that you're owning simply be able to pay out the dividends directly and be able to benefit from the lower rate. But this gives a fairly small number of countries, and usually that number of countries ends up being ones that are not low tax. So Georgia has this really unique position where you can get a low tax company, and you can get no limitation on benefits clause, and you can be in a situation where you can pay out dividends, and that can be a qualified dividend, which can save you some complexity of going through other options where you have to add another layer of companies. So really interesting quirk of history that this happens. I'm curious to see who all got it right in the comments below. There's a bunch of different ways when we're doing international planning that we'll kind of play around with this. It's one of the things that most people don't have the time or the energy to go through reading all these tax treaties, and that's one of the things that we do. So we can figure out what is the best solution for you. So anyway, if you're interested in solutions in general, please reach out to me. If you're interested in learning more about these subjects, please check out our other videos, and I will look forward to seeing you on the next video.